Welcome to the lecture, or mini lecture, for Unit 2 of Governmental Accounting and Auditing. This is when you're going to really start to get into the building blocks of governmental accounting, and where I think you will see most of the similarity between governmental accounting and accounting for companies, publicly traded companies, corporations, not-for-profits, when we're talking about the very basics like measurement focus and basis of accounting. The measurement focus is talking about the types of items that the types of assets and liabilities that are being measured through accounting. For instance, a measurement focus on cash is just looking at cash coming in and cash going out, whereas the antithesis of that, the polar opposite, is accrual, which is looking at economic resources, or all types of resources, not just those that are in cash form, but promises to pay, capital assets, long-term liabilities and short-term liabilities, inventory, investments, all types of resources at the government's disposal as they come in or go out are being measured under the economic resources measurement focus and the accrual basis of accounting. Basis of accounting essentially talking about how you measure and when you report inflows and outflows of resources in an entity. The accrual basis of accounting is the most comprehensive. It's the one that you are probably most familiar with in terms of looking at not-for-profits and companies. It's measuring all the inflows and all the outflows, regardless of whether they involve cash or not. If you were looking at a typical city or state or village or county, a government, general purpose government, as they're referred to, is likely to have 9 financial statements in a typical financial report, and 6 of them use the accrual basis of accounting and economic resources measurement focus. The 3 exceptions are a cash flow statement for the proprietary funds and the 2 governmental funds, which use modified accrual and a current financial resources measurement focus. And a lot of what you will find challenging, I think, is understanding some of the differences between a full accrual or accrual on the one hand and modified accrual on the other. Accrual, as I already mentioned, you're capturing everything so that you can get both a short-term and a long-term view of a government's finances, but the governmental funds, in using modified accrual and measuring current financial resources, are looking at a much shorter term perspective on the government, really what its financial health is in the very near term. In looking at the governmental funds and modified accrual and current financial resources, you will notice that not everything that you see in those funds is in fact financial. There are, for instance, inventory. Quite often, and not everything is current. You will sometimes see some notes that aren't maturing for more than a couple of years, like tax anticipation notes or revenue anticipation notes, known as TANs and RANs. You may see some long-term receivables. If a government has a revolving loan fund that it reports among the governmental funds. The reason for this is that modified accrual is not a conceptually pure basis of accounting. If you were to sit down and say, I'm going to create a new basis of accounting that gives me a really good perspective on the short-term finances of a government, you would not come up with something that looked like modified accrual and current financial resources. You would come up with something that just had short-term resources in it. There wouldn't be any inventory, there wouldn't be any long-term receivables, and so on. But the fact of the matter is that this is essentially a convention that has developed over time that mimicked practice, that provided what people in and around government needed in terms of financial reporting, and it is not necessarily, therefore, something that really purely meets its purpose, which is to give you a short-term view of the government's finances, particularly relating to its bread and butter services, those that are tax supported, like police, fire, sanitation, education, health and welfare, and so on. In understanding inflow and outflow recognition, I think you will find that the recognition of revenue and even expenses too for exchange transactions, the kinds that businesses engage in, meaning there's two or more willing parties in the transaction who are exchanging value for value. I give you a hamburger, you give me $1 in return. We've just had an exchange transaction. You will find that those are dealt with similarly by governments as they are by companies and not-for-profits. And you will also find that in looking at these two bases of accounting, accrual and modified accrual, that they mostly treat them exactly the same. Both are required to be measurable, meaning you can actually put a number on the transaction, and realizable, meaning that they're actually going to receive payment. The one thing, though, that is very different is that under modified accrual, the resource inflows also need to be considered available for expenditure during or soon after the reporting period. So in addition to being measurable and collectible or realizable, they also have to be available. Available, means that either it's going to be collected during the year or soon enough after the end of the year that it can be used for current period expenditures. For property taxes, that is set in the accounting standards at 60 days beyond the end of the fiscal year. The other revenues, a government will choose its own availability policy and disclose it in the summary of significant accounting policies. There is an encouragement or a hope that governments will select a single period, if not the same 60 days as property taxes, another period that applies to all of its revenues, but sometimes they will vary those availability periods depending upon the type of revenue. Expenses and expenditures are both recognized when they are incurred, but expenditures are outflows of current financial resources, whereas expenses are outflows of any type of resource, of economic resources. So you have charges for the use of capital assets, in other words, depreciation, under expenses, but under expenditures, there's no flow of current financial resources related to depreciation, so it's not an expenditure. You're only going to be looking at when there has been an outflow of a current financial resource, either cash or a short-term promise to pay, or some other resource flow that qualifies as a current financial resource. It's important that you take out of this chapter an understanding of the various types of activities. There are 3 that governments engage in that have an impact on the type of financial reporting they do: governmental, business type, and fiduciary activities. The government-wide financial statements encompass both the governmental and business type activities, and you will see that they're required to be presented separately and then totaled for the primary government, but not fiduciary activities, because those are activities in which the government is acting as a trustee or agent for resources that belong to other people or other governments. Or other entities. So since they're not the government's resources, and any liabilities connected with those activities aren't liabilities of the government, they're not included in the government-wide financial statements, because that might give you an erroneous picture of the government's finances, because those are not their assets to call upon, and they're not their liabilities that they have to satisfy. And so the only place that you see the fiduciary activities is reported in fiduciary fund financial statements. The governmental activities in the government-wide statements are composed of the governmental funds, which are reported in their own 2 financial statements, and then the internal service funds, which are reported in the proprietary fund financial statements along with the enterprise funds. It's almost always the case that governmental activities comprise governmental funds and internal service funds. I can't say it's 100% true, but the vast majority of the time it is true. Business type activities then are usually the same exact activities that are accounted for in the enterprise funds. In terms of other things that you need to know what the three categories of funds are: governmental, proprietary, and fiduciary, and what the fund types are within each of those categories: the 5 governmental, the 2 proprietary, and the 4 fiduciary fund types. You also need to know what the names of the financial statements are: the government-wide statement of net position and statement of activities, the governmental funds balance sheet and statement of revenues, expenditures, and changes in fund balance, the proprietary fund statement of net position, statement of revenues, expenses, and changes in fund net position and cash flow statement, and then the fiduciary fund financial statements, the statement of fiduciary net position and the statement of changes in fiduciary net position. And then you also need to understand the issue of how major fund reporting is done in the governmental funds and the enterprise funds versus reporting by fund type, which means that all the funds that a government has of a particular type are aggregated together and presented in a single column. And then lastly, the last thing I want to share with you is a little bit of transaction analysis to point out the most obvious differences between accrual and modified accrual. That is, the way that they treat transactions that involve capital assets and long-term liabilities. To show to you and to make a point that even though the governmental funds using modified accrual don't report capital assets or long-term liabilities, that doesn't mean that they're not affected by those transactions, because both transactions will involve flows of current financial resources that are measured under modified accrual. So a very simplistic example: imagine a government purchases a computer for $300, pays for half of it in cash, and the remainder is going to be paid in 6 months. So under accrual, it has $150 less in cash under assets, and it now has a $300 computer, $300 more in equipment. It also has a $150 account payable. Now, there's no effect on net position because essentially what the government has done is it's changed the mixture of its assets, and it's financed it in part by taking on a new liability. I should also maybe step back for a second and make sure that you all understand this equation. The accounting equation was much simpler when all we were talking about was net assets, and it was assets minus liabilities. But governments also report, and very soon will be increasingly reporting more of, things called deferred outflows of resources and deferred inflows of resources. You should make sure that you understand what those are. It's a concept that will take a little time to grasp, but it's a very important concept for governments because it speaks to the issue of interperiod equity, or the degree to which a government lives within its means from year to year, that it raises enough resources to cover its cost and doesn't push costs off to the future. And so we'll learn a lot more about deferred inflows and deferred outflows over the course of the semester, but they're a part of the transaction. Deferred outflows have a debit balance, deferred inflows have a credit balance, and so assets plus deferred outflows minus liabilities minus deferred inflows equals net position. Under modified accrual, the transaction starts off the same. There's $150 less in cash, and they have a $150 account payable. That's how the government financed the purchase of the computer. But we know that under modified accrual, they don't report capital assets. So there's not going to be a plus 300 in equipment here. What there is a capital expenditure. There has been an outflow of $300 in current financial resources, half of it cash and half a short-term promise to pay, and that reduces the fund balance of the government. And in this case, it actually makes it, at least temporarily, a negative fund balance. Now, you might look at these and say, well, which one is right? Well, they're both right because they both are looking at different things. Accrual is looking at things in a much longer term perspective. And so from an economic perspective, this government is in exactly the same position it was before. It's purchased some equipment that it didn't have before, but it's also surrendered some cash and it's made a promise to pay, and so financially, economically, it's still in the same place. But looking under modified accrual, you're looking at a shorter term perspective. What are their short term resources? And this government has used up all of its short term resources, at least at this point in time, by buying this computer. So depending upon the perspective you're looking at, either you pick either modified accrual or accrual to inform what your interests are. Now, let's say the government turns around and sells the computer for $300. So we don't have to deal with gains or losses or anything like that. Under accrual, it now has $300 in cash, and the equipment is removed from the books. And again, it's in exactly the same economic position. There's no effect on net position whatsoever. Under modified accrual, you have the plus 300 in the cash, but remember, we didn't recognize a capital asset here. So the balancing entry is revenue, that they got $300, an inflow in current financial resources, and that's considered revenue. Now, government issues general obligation bonds. These are tax-backed bonds. They're going to be repaid with the general resources of the government, which for the most part is taxes. So from an accrual perspective, they have $300 in cash. That's the proceeds of the bonds. In reality, it would be something less than that after you subtract transaction costs and such. But to make it simple, we'll just pretend there aren't any transaction costs. And this government now also has a long-term liability, a $300 bonds payable. So again, there's no impact on the net position of this government. It's in the same position it was before. It has more in cash, but it also owes more. From a modified accrual perspective, they have the $300 in cash, which is actually reported under modified accrual as an other financing source. It's an inflow of resources that is not, revenue. It's a flow of current financial resources into the government, but we don't, even under modified accrual, treat bond proceeds, the proceeds of borrowing, as a revenue. There's no long-term liability reported here. So from a short-term perspective, the government is better off. It has $300 more in current financial resources. But that you think about that in concert with the accrual basis information, which shows that, that in fact they still do have that $300 that they're going to have to repay over the long run. Now, government is repaying the debt. That's called debt service, when the payments it makes on its debt. And like any borrowing, a mortgage or a personal loan, a portion of it is principal, repaying the actual outstanding bond, and a portion of it is interest expense. So under accrual, they have $75 less in cash. That's the amount of the payment that was made. The principal amount reduces the amount of the outstanding liability, and the interest portion reduces net position. It's an expense. That's the cost of borrowing somebody else's money. Under modified accrual, though, remember, we don't have the long-term liability reported here. So you have the $75 in cash, and the entire amount is debt service expenditure. There's an outflow of $75 of current financial resources. Governments will report the principal and interest portions of the expenditures separately, so you can see how much was principal expenditure and how much was interest expenditure. But the entire amount is an expenditure because it all results from an outflow of current financial resources. And then the last thing I want to show you is the reason why a lot of people think that accrual is the only way to go in terms of reporting for governments. I don't believe it's the only way to go. I believe that modified accrual or something else in its place that provides short-term financial perspectives on a government in addition to the long-term is important. But the further away you move from accrual, the easier it is to manipulate the accounting to make the situation look perhaps better than it really is. So I'm going to switch the order here. Instead of starting with accrual, we're going to start with modified accrual. And the example here is a government that it has salaries payable that it needs to pay. Its employees worked, and it's going to have to make payroll. And so it has a $300 salary payable and $300 salary expenditure under fund balance. So goes out and it borrows from the bank $300, so it has an inflow of cash. We know that's a $300 other financing source. It's not treated as revenue even under modified accrual. And then it uses those proceeds to pay off the liability, the salaries payable. So the salaries payable is eliminated and $300 in cash comes out. And so if you compare the beginning numbers before these transactions and the ending numbers, there's absolutely no change. So from a short-term perspective, that's actually correct. From a short-term perspective, they have exactly the same amount of current financial resources that they had before these transactions took place. But we all know that they have this loan that they're going to have to repay over a number of years, and you see that when you look at the accrual numbers. But if you were only to focus on the modified accrual, you wouldn't realize that they still had this outstanding loan, and that in the long run they're worse off than they were before, because under full accrual, the cash is balanced in your debits and credits with a credit to loan payable of $300. They make the salary payments, which eliminates the salary payable, but the loan payable is still there. And so from the perspective of this government, it's got $300 more in liabilities, and its net position has decreased by $300. So you can see that in the longer term, this government is worse off. And that's why it's important to look at both. And with that, I don't have anything more to say. Those are the major things that I think you ought to take out of the second chapter of the textbook. And I look forward to having a discussion with you about it on the course website.